Welcome to the deep dive. If you're an international student, a worker from abroad, or a long-term visitor in the US, we're about to get into something that is probably a source of major stress,
Oh, absolutely. U.S. income tax.
specifically for your 2024 filing. The rules are complex, they're not intuitive, and we're just going to dive straight into the critical updates you need to know about.
That's the plan. Our mission today is to, cut through all that confusion. We want to help you define your filing status, figure out what the IRS actually calls U.S. income, and highlight some really important geopolitical changes.
Changes that directly affect your tax bill.
Drastically.
Okay, so let's start with the absolute foundation. If you get this one thing wrong, everything that follows is probably going to be wrong too.
That's right. It's the distinction between being a resident alien and a non-resident alien for tax purposes.
And they sound similar, but the difference is massive.
You did night and day. If the IRS sees you as a resident alien, you're treated just like a U.S. citizen. You have to pay tax on your worldwide income.
Everything you earn anywhere on the planet.
Exactly. But as a non-resident alien, you're only taxed on income from U.S. sources, plus certain income that's effectively connected to a U.S. business.
Okay, that is a huge difference. So for most people listening, the goal is probably to maintain that non-resident status. How is that status determined?
Well, there are two main ways you become a resident for tax purposes. The first is the green card test. Pretty straightforward. If you're a lawful permanent resident, you're a resident for tax.
And the second one?
The second one is what affects almost everyone else, the substantial presence test.
Right. And since most of our listeners are probably here temporarily, students, trainees, this is the real battleground. Walk me through the math on this.
Okay, so the test looks back over the last 3 years. For your 2024 tax return, you first take all the days you were physically in the U.S. in 2024.
All of them.
All of them. Then you add 1/3 of the days you were here in 2023. And finally, you add 1/6 of the days from 2022.
So you're adding up fractions of days from previous years. And if that grand total hits a certain number...
If it hits 183 days or more, you generally meet the test. You're a resident.
Wow, that sounds like you need a very detailed calendar. Let's use an example. What if someone was here for, say, 120 days each of those 3 years?
Good example. So you take 120 days from 2024, then 1/3 of 120 from 2023, which is 40,
Okay.
and then 1/6 of 120 from 2022, which is 20. So you have 120 plus 40 plus 20.
That's 180 days.
Right, which is just under the 183-day threshold. So in that case, you would not meet the test. You'd remain a non-resident alien.
See, that shows how close you can cut it. But this leads us to what is really a saving grace for so many students.
The exempt individual status. This is so critical.
Who qualifies for this?
We're talking about non-immigrant visa holders. So F1 students, J1 scholars and trainees, M1Q visa holders. If you're an exempt individual, you get to just ignore those days. They don't count toward the 183-day test.
For how long, though?
For students on F, J, M, or Q visas, you're exempt for the first 5 calendar years you're in the U.S.
The first 5.
And a really important point, it's cumulative. Any part of a calendar year counts as a whole year. So if you were here for 1 semester in 2020 on an F1, that's year 1. Gone.
So if you're getting close to that 5-year limit, you have to be incredibly careful because you could just suddenly tip over into being a resident alien.
Precisely. And the tax implications of that are enormous.
Are there other days that can be excluded from the count?
Yes, a few others. If you're a regular commuter from Canada or Mexico, for instance, those days don't count. Or if you're just in transit through the U.S. for less than 24 hours.
What about a medical emergency? Say you get sick and can't leave.
That's another one. If you couldn't leave because of a medical condition that started while you were in the U.S., you can exclude those days too. The key is that the condition had to arise here.
Okay, before we get into the really shocking treaty changes, let's cover the most basic thing you need to even begin this process: an ID number.
You absolutely have to have one, a taxpayer identification number, or TIN. If you're authorized to work, you probably have a Social Security number, an SSN.
But what if you aren't? Like a dependent spouse or a student without a job?
Then you must apply for an individual taxpayer identification number, an ITIN. You use Form W-7 to do that. Without an SSN or an ITIN, the IRS, well, they can't process anything for you.
You're invisible to the system.
Exactly.
Okay, let's pivot now. Because it's not always about how many days you're here. Sometimes the biggest factor in your tax bill is what's happening geopolitically.
That is such a crucial point. Global events have a direct line to your wallet, and for 2024, there are 3 really high-impact treaty changes that people need to know about.
Let's start with Hungary. You said this one is the most dramatic.
It is. The U.S.-Hungary tax treaty was terminated. It's gone. Effective January 1st, 2024, for taxes withheld at the source.
So what does that mean in practice?
It means if you're a Hungarian national and you get U.S. source income, maybe dividends or royalties, that income used to get a treaty benefit, a lower tax rate. Now, it gets hit with a statutory 30% withholding rate.
30%, that's the default maximum rate.
It's the default rate, yes.
Yeah.
Moving from maybe a 10 or 15% treaty rate to 30% is a huge financial shock. And for Hungarian students and trainees, any special elections they can make under the treaty are also gone.
Wow. And similar things happen with Russia and Belarus.
Yes, though slightly different. The U.S. partially suspended its tax treaty with Russia, effective August 16th of 2024. So starting on that date, payments to Russian recipients also face that full 30% withholding.
So for Russians, 2024 is split into 2 different tax periods.
That's a great way to put it. It creates this dual complexity. And with Belarus, there was a partial suspension of the old USSR convention, as it applies to them, which kicked in late in the year, December 17th.
It just shows how fast your personal tax situation can change based on world events.
Instant.
Okay, let's get into compliance. You know your status. You know about the treaties. What is the absolute bare minimum you have to file as a non-resident alien?
This is maybe the most important administrative takeaway of our whole conversation. Every non-resident alien has to file something, even with zero income.
Wait, why would you file if you didn't earn any money in the U.S.?
Because you have to officially declare and prove your non-resident status. You do that with Form 8843, the Statement for Exempt Individuals.
So this is for all the F1 and J1 students?
Every single one. It's how you tell the IRS, hey, I'm here, but my days don't count for the substantial presence test. If you fail to file Form 8843, you can lose the right to exclude those days.
And if you lose that right, you could accidentally become a resident and owe tax on your worldwide income.
The stakes are just. They're immense. Form 8843 is your shield. You have to file it.
Okay, that's for zero income. But if you did earn U.S. income, what's the form then?
Then you move up to the main return, which is Form 1040-NR. That's the U.S. non-resident alien income tax return. That's for any U.S. wages, taxable scholarships, investment income, you name it.
And the deadlines for 2024 filing. Let's nail those down.
2 key dates. If you were an employee and had U.S. income tax withheld from your wages, your deadline is the normal one, April 15th, 2025.
And if you didn't have wages with withholding?
Then you get a bit more time. Your deadline is June 16th, 2025.
And there's a really important catch about filing on time if you want to claim deductions, right?
A huge one. To claim any deductions or credits, the law says you must file a timely return. That generally means within 16 months of the original due date. If you file later than that, you lose them.
Or you just lose the ability to lower your tax bill.
Sure.
Let's talk about couples. There is a special choice available if a U.S. citizen is married to a non-resident.
Yes, the non-resident spouse choice. It sounds good on the surface. The couple can choose to treat the non-resident spouse as a U.S. resident for the whole year.
Which lets them file a joint return, which is usually better. So what's the catch?
The catch is enormous. By making that choice, both spouses agree to be taxed on their
worldwide income.
Their worldwide income for the entire year. You trade the convenience of filing jointly for the massive burden of global tax reporting. It's a huge decision.
Okay, let's shift gears and do a real deep dive on the kinds of income that cause the most confusion, starting with scholarships.
Right. With scholarships, it all comes down to what the money is for. If a grant only covers tuition and required educational expenses, books, lab fees, that kind of thing, it's generally not taxable. You don't even report it.
But what if it covers your living expenses?
Then it's taxable. Any money for room, board, travel, or any money that's actually payment for services, like being a teaching assistant, that is all taxable income. You'll usually get a form called a 1042-S detailing those amounts.
Let's talk about investments. If a non-resident invests in the U.S. stock market and has capital gains, what are the rules?
This one depends 100% on how many days you were physically in the U.S.
The 183-day rule again.
Exactly. Net capital gains from U.S. sources are taxed at that flat 30% rate, but only if you were present in the U.S. for 183 days or more during that tax year.
So if you're a student who maintained non-resident status and was here for less than 183 days, those gains could be tax-free.
Generally, yes, they're tax exempt as long as they aren't connected to a U.S. business.
And what about dividends or interest?
Those are usually subject to that flat 30% withholding tax unless a treaty gives you a lower rate. There is an exception for something called portfolio interest, which is often exempt, but that's a more specific category.
And one quick note on digital assets.
Yes, very important. Just like U.S. citizens, you have to answer the question on Form 1040-NR about whether you engage in any transactions with digital assets. Do not leave that box blank. The IRS is watching crypto very closely.
Okay, let's tackle what might be the single biggest headache for international students. FICA taxes.
Social Security and Medicare, this is a massive, massive problem.
The law is clear, right?
The law is perfectly clear. Non-resident F1 and J1 students are exempt from FICA taxes, period. The problem is, university payroll systems often make mistakes. They treat everyone like a resident and withhold the tax in error.
So a student looks at their W-2, sees thousands of dollars missing for FICA. How do they get that money back?
It's a process, and not a fun one. Step 1, you must go to your employer first. Ask them for a refund. If they can fix it before they've sent the money to the government, that is by far the fastest way.
But what if they say, sorry, too late, we already sent it to the IRS?
Then you have to file a claim directly with the IRS yourself. You'll need 2 forms, Form 843, which is the general claim for refund, and Form 8316, which is specifically for this situation.
And this is where we need to be really honest about the timeline.
We have to be. We have to caution you, this is not a quick process. People who have gone through this report that it can take, well, 1 to 3 years to get that refund from the IRS.
1 to 3 years. That's why going to the employer first is so critical.
Absolutely.
Now, to wrap up income, there is one very specific but very valuable tax benefit available to just one group.
Yes, this is a huge advantage, but only for students and business apprentices from India. Under the U.S.-India Tax Treaty, they are the only group of non-residents who are allowed to claim the standard deduction.
And the standard deduction is, it's a significant amount.
It's huge. For 2024, for a single person, it's $14,600.
Yeah.
Being able to just subtract that from your taxable income is an incredible benefit that almost no one else gets.
All right, let's touch on one last complicated situation.
Yeah.
Your status changes mid-year. You arrive and become a resident, or you leave and become a non-resident.
This creates what's called a dual status alien year. You're basically 2 different taxpayers in the same year. You're a non-resident for part of it and a resident for the other part.
And the biggest restriction here is?
You lose the standard deduction completely. It's a big financial hit.
Yeah.
And filing gets complicated. You essentially have to file both forms, a 1040 and a 1040-NR, with one attached to the other as a statement.
And for anyone planning to leave the U.S. for good, there's one last hoop to jump through. The sailing permit.
Yes, the Certificate of Compliance. It's often called a sailing or departure permit. Before you leave, you generally have to get clearance from the IRS to show your taxes are settled.
How do you do that?
You'll file either a short form, Form 2063 if you had no taxable income, or a longer one, Form 1040C if you did. It's the government's final check before you depart. So if we bring this all together, the main takeaway is that compliance is mandatory. You have to get your status right with a substantial presence test, you have to get a TIN, and you absolutely have to file the right forms, even if it's just that Form 8843.
And here's a final thought for you to take away from this. Given all this complexity, especially with the treaty changes and those frankly painful FICA refund delays, the penalties for getting this wrong aren't just fines. The real penalty is the loss of financial benefits, like losing your deductions for filing late, and the incredible administrative headache you create for yourself. The stakes are high, so informed compliance isn't just a good idea, it's essential.